Most people think economic problems happen suddenly. A crash, a breaking point, one big event that changes everything overnight. But real financial damage doesn't happen like that. It builds quietly, layer by layer, wave after wave. And by the time most people realize what's happening, the damage is already in motion. Right now, something like that is unfolding inside the American economy. Gas prices are rising fast. Oil has surged sharply, and most people believe that's the whole story. But it's not. That's just the first visible signal. What you're seeing right now is only the beginning of a much larger chain reaction. And the most dangerous part is this. Your brain is already convincing you that everything is manageable, when in reality, the real impact hasn't even started yet. Let's start with what you can clearly see: gas prices. Across the United States, the average price has jumped significantly in a very short time. And when you look at that number at the pump, your brain does something automatic. It calculates the immediate impact, maybe $10 more, maybe 15 extra per week. It feels annoying, but not dangerous. So your mind categorizes it quickly, inconvenient but manageable, and then it moves on. But that reaction is exactly where the real problem begins, because gas is not the main issue, it's just the trigger. Behind it, there are multiple waves forming, each one larger, each one delayed, and each one targeting a different part of your financial life. The second wave is already building: groceries, but not everything in your cart, the most sensitive items, fresh produce, milk, meat, anything that depends on fast transportation and refrigeration. These products rely heavily on diesel, and diesel prices in the US have surged dramatically, which means the cost of moving food across the country has increased almost instantly. But here's what most people don't realize: you won't see the full impact immediately. Retailers don't raise prices overnight. They try to absorb the costs. They delay the increase, but they can't do that forever. Eventually, the pressure builds, and when it does, prices adjust quickly. What feels stable today can shift within weeks, and when it happens, it won't feel gradual, it will feel sudden. Now, the third wave is even more dangerous, because it's almost invisible right now: fertilizer. Most Americans never think about fertilizer, but it's one of the most critical parts of the food system, and it is heavily dependent on energy. When energy prices rise, fertilizer becomes more expensive to produce. At the same time, global supply disruptions make it harder to access, which means farmers are now paying more to grow the same crops. But here's the key detail: you won't feel this today. You'll feel it months later, during harvest season, which means the food you'll buy later this year is already becoming more expensive right now, and by the time prices rise, it will feel unexpected, even though the cause started months earlier. The fourth wave is something people underestimate: air travel. Jet fuel prices have surged sharply, and airlines don't price tickets in real time. They plan months ahead, which means higher fuel costs today translate into higher ticket prices in the future. Even if oil prices fall, ticket prices don't drop immediately. So travel becomes more expensive, quietly, gradually, until one day you check flight prices and realize everything is changed. And then comes the fifth wave, the one almost nobody is thinking about: interest rates. Before this, there was a clear expectation in the American economy. The Federal Reserve would begin cutting rates. Borrowing would get cheaper. Mortgages, car loans, credit cards, everything would become more affordable. But rising energy costs push inflation higher, and higher inflation forces the Federal Reserve to hold rates, or even raise them, which means borrowing stays expensive, or becomes even more expensive. And that changes behavior. People delay buying homes. They delay upgrading cars. They postpone big financial decisions, not because they can't afford them today, but because they don't feel confident about tomorrow. And when millions of Americans make that same decision at once, the entire economy slows down. Now here's where psychology becomes important. There's something called anchoring bias. When your brain faces a complex situation, it simplifies it. It picks one visible number and treats it as the entire story. Right now, that number is gas prices. So your brain assumes that if gas is manageable, everything else is manageable too. But that's not reality. That's a shortcut, and shortcuts can be expensive, because while you focus on one visible number, multiple invisible changes are building behind the scenes. By the time they become obvious, your ability to react is limited. This pattern has happened before. Energy shocks don't stay isolated. They spread into groceries, into services, into everyday life. And by the time most people understand the full impact, their purchasing power has already declined. Now let's talk about something even more personal: your investments. When markets become unstable, something shifts inside your brain. Fear takes over. You start thinking about protecting what you have, avoiding further losses, maybe even selling everything. This is called loss aversion, and it's powerful, because losing money feels much worse than gaining the same amount feels good. So your instinct is to act, to escape the discomfort. But history shows a different pattern. During major geopolitical events, markets often fall in the short term, but they also recover, and the recovery usually happens when people least expect it. The strongest market days are often very close to the worst ones, which creates a problem. If you exit during the fall, you risk missing the recovery, and missing just a few strong days can dramatically reduce your long-term returns. This is what creates the gap between what the market returns and what investors actually earn, not because people are intelligent, but because they react emotionally. Now, there is one scenario that worries economists the most: stagflation. Rising prices combined with slowing economic growth. It's difficult to fix, because the tools used to solve one problem make the other worse. Raising rates controls inflation but slows growth. Lowering rates boosts growth but increases inflation. There is no clean solution, and historically, energy shocks have been one of the most consistent triggers for this environment. That's why this moment matters. But here's something important. What happens to you financially is not just about the economy, it's about how you respond to it. The people who come out stronger are not the ones who predict everything perfectly. They are the ones who adjust early. Simple actions, taken before pressure builds: reviewing spending, strengthening savings, continuing investments, reducing high-interest debt. These actions are not dramatic, but they create stability, and stability prevents emotional decisions. One of the most important things right now is to avoid panic, especially with investments. Moving everything to cash might feel safe, but it introduces another risk: inflation and lost opportunity. There is no risk-free option, only different types of risk. Next, your emergency fund becomes critical, not just financially, but psychologically. Knowing you have a buffer changes how you react. It allows you to think clearly, instead of reacting emotionally, and that clarity is incredibly valuable. Then comes awareness, understanding where your money is going, before these waves fully hit, because once they arrive, adjusting becomes harder. And finally, consistency, continuing to invest regularly, even when it feels uncomfortable, because volatility creates opportunity, but only for those who stay invested. The truth is simple: economic shocks don't destroy wealth instantly, they reveal behavior. They show who reacts emotionally and who responds strategically. Right now, your window is still open. Most people will wait until the impact becomes obvious, until the pressure becomes real, and by then their options will be limited. But you're seeing this early, you're thinking about it, and that already puts you ahead. The question is not whether uncertainty exists, it always will. The real question is this: will you let uncertainty control your decisions, or will you control how you respond to it? If you want to understand money, behavior, and long-term wealth, subscribe to Ion Invests.